Let's get the latest business news now, and it's dominated this Monday by the collapse of Silicon Valley Bank and the fallout from that. Will US regulators have unveiled a plan that they say will guarantee the funds of depositors at the bank? Our business editor, Charles Pellegrin, is here for more on that story.
Hi, Sharon. Yes, the US government stepping in an effort to shore up the country's financial system and avoid too broad of a spillover to other institutions. This is the result of consultations over the weekend after Silicon Valley Bank's failure on Friday. Now, with lots of pressure both from the banking industry and from some politicians for forceful government intervention, that's a big part of the rescue plan will be to find a buyer for Silicon Valley Bank. France 24's Catherine Viette tells us more about what we can expect.
Looking to stave off a potential banking crisis, the government has stepped in, promising that taxpayers would not bear the cost of Silicon Valley Bank's collapse on Friday. U.S. President Joe Biden sought to reassure jittery depositors.
I'm firmly committed to holding those responsible for this mess fully accountable and to continuing our efforts to strengthen oversight and regulation of larger banks so we're not in this position again.
Biden's tough stance comes as a second bank failed, New York-based Signature Bank. It was taken over by regulators on Sunday. The Treasury, Federal Reserve, and Federal Deposit Insurance Corporation announced a plan to protect bank clients' money.
We want to make sure that the troubles that exist at one bank don't create contagion to others that are sound, and a goal always of supervision and regulation is to make sure that contagion can't occur.
The plan, known as the Bank Term Funding Program, will offer loans of up to 1 year to banks and other eligible depository institutions. All deposits, insured and uninsured, will be covered, and the funds will be backstopped by up to $25 billion from the Treasury. But those not protected include shareholders and certain unsecured debt holders. Silicon Valley Bank was attempting to raise around $2.25 billion to plug a loss caused by selling assets which had been affected by higher interest rates when it ran into trouble.
And the spillover of SVB's collapse, not just limited to the United States, the UK finance minister confirming this morning that the Bank of England had facilitated a sale of SVB's UK subsidiary to HSBC, the Hong Kong and Shanghai Banking Corporation, adding that all deposits will be protected with no taxpayer support and that no other UK banks are directly materially affected. Rishi Sunak, the British Prime Minister, had said news would be imminent before boarding his flight to San Diego to meet with US President Joe Biden and Australian Prime Minister Anthony Albanese. Elsewhere, French Finance Minister Bruno Le Maire saying this morning on French TV there is no specific risk on the French banking sector. And the crisis in the banking sector with potentially wide-ranging implications, including on monetary policy. At least that's what Goldman Sachs believes in a note on Sunday. Its economist Jan Hatzius saying, in light of the stress in the banking system, we no longer expect the Fed to deliver a rate hike at its next meeting on March 22nd. Prior to this episode, the common position was that the Fed would keep interest rates higher for longer in order to continue its fight against persistent inflation and very low unemployment. And let's have a look at how the stock markets are reacting to all this. European markets opening this week's trading lower following the news of the US's plan to protect depositors and following the sale of SVB UK to HSBC. You can see the FTSE in London down just under 1/3%, the Paris CAC 40 down almost 0.5%, and the DAX in Frankfurt down just below 0.2%. And we saw mixed trading in Asia. The Hang Seng in Hong Kong rising there over close to 2%, buoyed by its own tech stocks. The Nikkei in Tokyo, though, finishing the session below 1%. And let's finish with a quick look at what's happening in China, where new Premier Li Qiang held his first press conference after being appointed at the head of the State Council, the country's cabinet. He emphasized his economic team would focus on stability and growth, jobs and prices, with many challenges facing the world economy. adding that reaching the 5% growth target that was set at the beginning of the two meetings this year, the annual two meetings, would be a difficult task. Take a listen.
China's economic growth target is set at about 5%, which is established after taking into account all factors. Of course, now we have a large economic volume that has passed 120 trillion yuan, and now there are many new challenges. In this high base, to reach the growth target of about 5% is not an easy task. We need to work harder.
That's it for the business, Sharon.
Thanks, Charles. That's our business editor here at France 24, Charles Pellegrin. Well, it's time now for our press review.